So many people tell you to invest into the S&P 500. They tell you that it's the best way to become a guaranteed millionaire. But what really is the S&P 500 and how do you invest in it? In this video, I'll be going over what the S&P 500 actually is, the best ways to actually invest into the S&P 500, as well as some of the best S&P 500 investments. So what exactly is the S&P 500? The S&P 500, which stands for Standard & Poor's 500, is an index of the 500 most powerful companies in the United States. The collection of stocks that make up the S&P 500 are designed to represent most of the composition of the United States economy. In other words, the S&P 500 is considered the benchmark to see how well the US economy is doing. The S&P 500 currently holds many companies that you've probably heard of: Google, Apple, Tesla, Meta, and more. Now, what does it actually mean to invest into the S&P 500? When you invest into the S&P 500, you're basically spreading out your money into 500 of the most powerful companies in the US. I don't know about you, but that's pretty promising. One important thing to note is that you can't directly invest into the actual S&P 500 index. You will need to choose investments that track the actual performance of the S&P 500 index. Now, how do you actually invest into the S&P 500? There are two simple steps that you can take. First, you need to open an investment account. This can be either a retirement investment account such as a Roth IRA or traditional IRA, or a regular brokerage. Then you want to deposit the money that you want to invest. Second, you want to choose investments that you want to buy inside of this account. Do you want to buy stocks for individual companies that are inside the S&P 500, or do you want to buy an index fund that tracks the entire index directly? I personally think the best way to start off is by buying an S&P 500 index fund, since you instantly diversify your investment portfolio and lessen your overall risk. S&P 500 index funds track the S&P 500 directly, which means that if the S&P 500 does well, so do your investments. Now, how much does it cost to invest into the S&P 500? If you want to invest into the S&P 500, there are three options and a few costs to consider. If you choose to invest into an S&P 500 index fund, if your index fund has no minimum, then you can usually purchase any dollar amount. But if your index fund does have a minimum, you need to purchase a minimum amount. If your index fund has an expense ratio, you will be charged that as a fee. An expense ratio is an annual fee expressed as a percentage of your investment. For example, if your expense ratio is 0.04%, on a $10,000 investment, you would pay $4. Now, if you're investing into an S&P 500 ETF, ETFs are similar to stocks in that they have a share price. Now, depending on your brokerage, you can either buy a full share or you can even buy fractional shares. Similar to index funds, ETFs also have expense ratios, so be on the lookout for what your fund's expense ratio actually is. If you're buying an individual stock inside the S&P 500, buying stocks have no minimum or expense ratios. Some stocks in the S&P 500 cost $100 or less, and some cost $500 or more. The only price that you'll pay is the current value of the stock. So for example, let's say you want to buy one share of Apple stock. As of this recording, you would pay $191 per share. Another question you may have is, should I invest into an S&P 500 index fund or an ETF? Both index funds and ETFs are great options for getting started with investing into the S&P 500. There are, however, a couple differences to consider. For example, ETFs can be bought and sold whenever the stock market is open, while index funds can only be bought and sold at a set price point at the end of the trading day. So let's go over a quick history lesson of the S&P 500. So you can see here that in 1957, the S&P 500 makes its debut to track the value of the 500 companies that have their stocks listed on the New York Stock Exchange and the Nasdaq. Between 1969 and 1981, the index gradually declined due to stagnant growth and high inflation. But between 1980 and 1982, the stock market prices rose and the S&P 500 climbed more than 840%. Between 2000 and 2002, the stock market experiences a bubble and the S&P 500 falls almost 25%. Between 2007 and 2009, the S&P 500 fell 49% from its new high during the financial crisis that has come to be known as the Great Recession. This decline was the largest drop in the S&P index since World War II. Between 2009 and 2020, the index experiences an almost 10-year bull market run. And for those of you that don't know what a bull market is when the stock market performs very well and continues to go up. Between 2020 and 2021, the S&P 500 surged from its pandemic lows and nearly gained 68%. The S&P 500 continued this trend into November 2021, and the index closed at an all-time high. The index began to drop early in 2022 and continued to fluctuate throughout the year and into 2023. In 2023, however, the S&P 500 gained 24%, which is really good returns for just one single year. If we take a look at another chart, we can see that the S&P 500 has returned an average of around 10% no matter what event was going on around the world. You can see all of these events throughout history, such as the Korean War, the Cuban Missile Crisis, the Vietnam War, the dot-com bubble, September 11th, 2001, the Iraq War, and even the pandemic. Even though there were so many world events that shook the economy, the S&P 500 continues to move upwards in the long term. Now, let's go over some of the best S&P 500 investments in my personal opinion. First off, we have the Fidelity S&P 500 Index Fund, otherwise known as FXAIX. If you take a look here, you can see that the current price sits at $168 per share. The current expense ratio sits at 0.015%, which by the way is very low and one of the lowest throughout all S&P 500 index funds. Its annual returns for 1 year sits at 26%, 3 years at 9%, 5 years at 15%, and 10 years at 12%. If you scroll down, you can see a chart with the growth of the S&P 500, and you can see the top 10 holdings in this index fund include Apple, Microsoft, Amazon, Nvidia, Alphabet, which is Google, Meta, Tesla, and more. FXAIX is an index fund that I personally hold in my portfolio, and it's really a long-term investment that I think will do very, very well. Now, if you're someone who uses Vanguard, the Vanguard S&P 500 index fund is also a great choice. So Vanguard's ticker symbol is VFIAX or VFIAX, and the current expense ratio sits at just 0.04%, which is very low as well. If you look at performance and fees for this one, you can see that the 1 year return sits at 26%, 3 years at 9%, 5 years at 15%, and 10 years at 11.9%, which is very close to Fidelity. If we look at what's in this fund, scroll down here, we can see that there's Apple, Microsoft, Amazon, Nvidia, Google, Facebook, also known as Meta, Tesla, and more. So the composition is very similar to the Fidelity. Now let's say you want to buy the same index fund but on Charles Schwab. Charles Schwab also offers the same index fund with the ticker symbol SWPPX. The total expense ratio for SWPPX is at 0.02%, which is pennies. If you look at the performance down here, you can see that in 1 year it returned 26%, in 3 years 9%, in 5 years 15%, and in 10 years at 11%. So very similar to Vanguard and Fidelity. Now what does this index fund hold? Very similar to the previous two, so Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta, Tesla, and more. Now let's say you want to invest into an S&P 500 ETF instead of an index fund. One of the best choices is the Vanguard S&P 500 ETF, also known as VOO. So this is actually one of the most popular Vanguard ETFs with an expense ratio of 0.3%. Let's look at the performance. 1 year at 26%, 3 year at 9%, 5 year at 15%, and 10 year at 12%. If you look at the portfolio composition, it's pretty much the same to the other index funds: Apple, Microsoft, Amazon, Nvidia, Facebook, Tesla, and more. Now there's another ETF from Vanguard called VTI, or Vanguard's Total Stock Market ETF, and this ETF actually tracks the entire stock market, so it holds more than 500 stocks. The thing about this ETF is that it's called the Total Stock Market ETF, and it tracks the entire stock market, but 80% of it is the S&P 500, so it's not too much different from VOO. The expense ratio sits at 0.03%, so pretty much $3 paid for every $10,000 invested. If you look at performance and fees, you go down here. The 1 year return sits at 26%, 3 years at 8%, 5 years at 15%, and 10 years at 11%. So very similar to the other ETFs and index funds. If you look at what it holds, we can go down here. Pretty much the same companies: Apple, Microsoft, Amazon, Nvidia, Google, Meta, Tesla, and more. Now another great ETF is called the SPDR S&P 500 ETF Trust, also known as SPY. This ETF does have a little bit of a higher expense ratio at 0.09%, but that's still only $9 for $10,000 invested. If we look at the performance of this ETF, we can see the performance here. So in 1 year, 26%, 3 years, 9%, 5 years, 15%, and 10 years, 11%. So very similar. If we look at the holdings, Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta, and Tesla, and more. Last but not least, we have the iShares Core S&P 500 ETF, otherwise known as IVV. You can see here that the expense ratio sits at just 0.03%, so $3 for every $10,000 invested. So let's look at the performance here. You can see that in 1 year, 26%, 3 years, 9%, 5 years at 15%, and 10 years at 11%. Let's look at the holdings here. Very similar: Microsoft, Apple, Nvidia, Amazon, Google, Meta, Tesla, and more. Now you're probably wondering, how much can I actually make by investing into the S&P 500? Let's say you start off with $100, right? And let's say every month you decide to invest $500 into an S&P 500 index fund. Let's say for the next 30 years, you invest with a rate of return at 10%. as it's been historically proven that around 10% is the average. After 30 years, your investment of $500 per month would grow to over $1.1 million. If you look at the pie chart here, you can see that your starting amount is at $100, your total contributions is only $180,000, but the total interest that you earn is over $900,000. If you scroll down here, you can see pretty much year by year how much money you would make. So starting in 2024, all the way to 2053, which is 30 years. You can see the starting amount, the annual contribution, the total contributions, your interest that you earn, and the end balance. So year by year, you can see that it pretty much increases very drastically. So 6,000, 13,000, 21,000, 29,000, 38,000, and so on and so forth, until in year 30 you reach over $1 million. That's pretty crazy, right? Let's say you're someone who can invest even more than $500 a month. Let's say you're someone who can invest $1,000 per month. After 30 years, your investment would not grow to $1 million, it would grow to $2.2 million. Unbelievable. So the moral of the story here is that the more money you get invested earlier on, the more money you'll make in the end, simply due to compound interest. And compound interest is the best thing in the entire world. Many investors buy S&P 500 index funds as core holdings in their portfolios, and for good reason. Investing into the S&P 500 is one of the best ways to diversify your investment portfolio and has historically proven to provide massive returns for investors over the long term. That is it for today's video, guys. Thank you so much for watching. If you're new here, my name is Paul and I talk all things money, finance, and investing. So if you like this video, please smash the like button and subscribe for more future content just like this. Your life is a masterpiece, so let's unlock your full financial potential together. And with that, I will catch you in the next video. Take care.